Hi, everyone. Friday, February 10th. Welcome to Three Things with Spyglass Lending, where we delve a little bit deeper into the real estate and mortgage-related industries, not your usual rigmarole. We're delving deeper, like we like to say. We want to give you the real, not just rip from the headlines. Let's get to it. Number one on the list, rate buydowns. Now, this was all the rage at the end of last year, certainly as rates skyrocketed, especially by the end of last year, the 30-year mortgage touching that 7% void. And then the rate buy downs became a big thing. Why? Well, people ultimately wanted to bring down the rate, number one, because they didn't want to think about elevated payments over the 30 years, the life of the loan. They'd rather pay money up front to bring that rate down. Or two, they had to do it just to qualify. They couldn't qualify in the sixes or close to 7%. So let's bring it down up front. We have the cash now. All of a sudden, the debt to income ratios come back in line, and that works. Or number three, and this is still a big thing, and a part of this article of what you're seeing in front of you, the rate buy downs given by the seller. The market softened, and all of a sudden it was no longer just a seller's market. It became a little bit of a buyer's market in certain pockets, certainly. So the sellers had to capitulate a little bit and say, okay, well, we're offering buy downs. And a big program that came out was 2-for-1 or 3-for-1 buy downs, meaning that the first 2 or even 3 years of the loan, the seller was buying down the rate for you, the buyer. And a lot easier for the first 2 or 3 years to digest, with the thought that within that period of time, if rates come back down, we can refinance down to a better rate if and when that 24 to 36 month period happens. And if not, okay, we'll stomach what it ultimately goes up to 3 years from now, or perhaps we'll sell or something else. And we'll see if those rates ultimately do come back down. But a lot of people, of course, thinking that they will. So this became the big program. And even though, and again, this is the last part of this, even though the rates have come back down a little bit off those highs, last month was pretty good. Still, what you're seeing here, rate buy downs happening at a pretty high rate, because the rate still is a lot higher, of course, than it used to be. Number 2 on the list, construction. We promised that we'd be covering construction a lot this year, and I want to keep that promise. We're going to stay on that train. Again, Spyglass Lending, known as very friendly to investors. We have funded a lot of flippers and certainly those doing ground-up construction for a long time. And here's a big one, UWM now in construction lending. UWM, United Wholesale Mortgage. This is the biggest wholesale lender in the country. They give a number of different loan programs. They're the benchmark that everybody else ultimately goes about. You might have heard Matt Ishby. You might have heard his name recently. Well, why? Because he's buying the Phoenix Suns. That's how well this company is doing. And ultimately, they're getting in the construction space. Okay, so they got into the DSCR space and the non-QM space for a period of time. They're doing HELOCs and all of that. They've been competitive in jumbo. In fact, they're one of the pioneers who were doing the 2-for-1 buy downs, and now construction lending, construction to perm lending. So here, we're giving you money to build, if you can do a primary residence, if you're a homeowner, and then we're giving you the permanent financing. It rolls over. Whatever the money we're giving you rolls over and becomes permanent financing for you. That's big, because there's not a lot of lenders who will do that. A lot of people have to go get a loan from somewhere else to do the construction and then have to refinance and get the permanent financing. Not always easy to do. And certainly, why are people wanting to do this? Well, there's a housing shortage out there, still continues, will go on for quite some time. So if you can build, better to do that. And the premiums are still crazy. The equity, the cost of a home has gone up so much in the last 10 years, even though, again, the market's softening the past couple of months. For the most part, who would rather pay the retail if they can ultimately buy the land and build themselves and have this amazing cushion of equity if they could do that? So this has kind of become a big thing. And if UWM is getting in the space, worth paying attention to. But what about the cost of all of this? How about the cost of construction? We heard so much about the volatility. Well, this is a really good chart that shows what happened between 2021 and 2022. And you can see here, it shows 2 things. One is the year-over-year percent and change, and the volatility index of where we're at and what to expect moving forward. Now, you could see pretty much everything on here. And this isn't just residential, obviously. This commercial, industrial. This covers a gamut here on the building and construction. But other than lumber and plywood, which was on its own roller coaster through COVID and ended up down 20%, 27% last year, everything else increase in a big way. And the volatility, maybe, because you can see that column might be low for glass and lumber and plywood and aluminum for the mill shapes. But other than that, you can go down the list and see some of these things have still expected in 2023 a pretty high volatility rate. And that includes gypsum products, fuel, which is massive, and certainly copper and brass. And it's worth watching. It's worth paying attention to ultimately what's going to happen. And the cost of construction, we must pay attention to it. Again, it's a huge economic barometer, because all of this comes down to, are we going to head into that recession or not? What are things really going to cost? Are mortgage rates ultimately going to come down? Because we've seen, and I talked about it in the last video, unfortunately, this week specifically has not been kind. After this really nice drop in the 30-year mortgage, we are back closer to the mid-6s than we are certainly to 6% or even below 6% than we were before. So expect that trend to continue. Thank you for joining me. This has been Three Things with Spyglass Lending. We'll do it all again next week.